Hey, hi everyone. Welcome to another video in our hedge fund series. So today we are going to discuss about long-term capital management hedge fund and the details about the founders of this particular hedge fund, the strategy that is used by this fund, and the performance of the fund, the challenges this fund has faced, and why it has failed, and what risk management lessons we can learn from this failure of the fund, and how the government has bailed this fund basically. So, long term capital management is a very important hedge fund, and it is one of the famous examples of systemic risk in modern financial history. Okay, and this LTCM, it is called basically in short form, was founded in 1994, Greenwich, Connecticut, and it was founded by very famous guys, John Meriwether, who is the former vice chairman and head of bond trading at Salomon Brothers, Myron Scholes, who is a co-developer of the Black Scholes option pricing model. So he got a Nobel Prize also in economics, and he um, developed this Black Scholes option pricing model. And Robert Merton, he is also an economist. He is also awarded the 1997 Nobel Prize for his work on risk modeling in financial derivatives. These three people have found this fund, hedge fund, called Long-Term Capital Management in 1994. Okay, and the education backgrounds of these founders are also very impressive. John Meriwether, he's an MBA from University of Chicago, and Madden Scholes is a PhD from University of Chicago in finance, and Robert Merton is a PhD from MIT School of Management in economics. And these all people are considered pioneers in quantitative finance and derivatives modeling. Okay. The strategies that are used by LTCM are core strategy, which is convergence arbitrage. So they primarily used fixed income arbitrage, betting that the prices of similar securities would converge over a time. Okay, like for example, is long undervalued bonds and short basically long the undervalued bonds. If the bond is undervalued, then you put a long position, take a long position in it, and you short the overvalued bonds. Okay, example U.S. Treasuries versus European sovereigns. Okay, for this example, if you consider U.S. Treasuries is undervalued, you take a long position in it, and if you consider the European sovereigns are overvalued, you take a short position in it. So that's what it is. So fixed income arbitrage, that is the strategy, and the aim is that both the prices will converge, and this is basically using convergence arbitrage because they are similar bonds. As I told you yesterday, if something has a correlation coefficient of near to 1 and it is diverging from the mean, there's a divergence in the price or pricing inefficiencies are there, they are bound to converge to the mean, and which is a basic fundamental concept of mean reversion. And yeah, we basically bet that whichever is lower than the mean will come to the mean, and whichever is far from the mean will come to the mean. So that's what is taking a long and a short position. But they took very high leveraged positions up to 25x to 30x leverage they have used, and they have used statistical models based on historical price correlations and volatility. Yeah, so price correlations and volatility also they have used. Performance of the fund was stellar. Returns were there from 94 to 97, 3 years. Average annual returns were about 30% after fees. Assets under management were 126 billion in notional positions with just 4 to 5 billion in equity. Okay, so challenges and collapses. 1998, the global financial crisis happened, and that was the trigger for the collapse of the fund. Asian financial crisis happened in 1997, and Russian financial crisis happened in 1998, which caused this massive global dislocations. And LTCM, this long-term capital management, had a significant exposure to Russian government bonds. So Russia, so no one thought that a government could default on their bond payments, and it was not modeled into their models, basically the statistical models and the quant models. But it did happen, and yeah, in the world of normal distribution, this is a very rare event. It's not supposed to happen. It's the probability of its happening is pretty much near to zero, but it did happen in the real world, and that's why such events are called as black swan events. And Russia defaulted on its bonds in 1998, and since these models didn't have any buffer for this, or didn't incorporate this particular events into the black swan events into its risk modeling or into its quant models. This caused the correlations to break down and markets to become illiquid and basically flight to quality. So US treasuries have soared, okay, and LTCM's short positions have ballooned. So LTCM has shorted the US treasury, assuming that the price is overvalued, but it has gone up and up, and basically it lost a lot of money in that short position. Consequences are fund lost 4.6 billion in less than 4 months, and leveraged multiple small pricings into massive losses. So the key reasons for failures are overconfidence in the models. They basically thought that they have totally removed the risk from the market by using some mathematics, and were thinking that maths could solve the real world risk altogether, which is not the case and which can't happen, is what is proved by this example. Um, Normal distribution assumptions fail. As I told, normal distribution assumptions will fail when a black swan event will happen. Black swan event we will cover. So black swan event is one event which is lying in the 5% of the distribution, 2.5 to 2.5 on the left to the right side of the distribution, right? So excessive leverage. So they have taken a lot of leverage. Also, 5 billion equity they have took leverage, supported by 125 billion in positions. Liquidity risk is ignored. Couldn't unwind positions in a panic. So because they had these huge positions and there was a panic in the market, they could not quickly get out of that positions because they have huge positions. Crowded trades were there. Many institutions followed similar strategies. When markets turned, exits were blocked, basically, and they were not able to exit the trade. So this poses, the black swan events could even pose, risk to the big institutions also, like hedge funds, and they could wipe out that hedge fund in a single event. Okay, so that's what is the main lesson. And when panic grips the market, you can't even exit that particular position. When you're leveraged and you have losses, you will be bankrupt, basically. Government bailout has been done because this was a systemic risk to entire global financial markets. And Federal Reserve Bank of New York organized 3.6 billion private bailout on September 23, 1998. 14 banks, Goldman Sachs, JP Morgan, Merrill Lynch, contributed to prevent collapse. The Fed did not use taxpayer money but coordinated with the bailout to avoid contagion. Risk management lessons in this is diversification is not enough if correlations break. Leverage amplifies both gains and losses and limits exposure. So leverage, when you take, it amplifies both gains as well as losses. And diversification alone is not enough. When correlations break, liquidity risk must be managed. More model assumptions can fail in crisis. So you want to get out of the position, you should be able to get out, and the liquidity risk you should be able to should be managed. Stress testing models against rare events is essential. They didn't test the model against the black swan event, and avoiding groupthink, crowded trades increase systemic vulnerability. LTCM was liquidated in 2000 and it became a classic case study in risk management, systemic risk, and financial arrogance. Regulatory scrutiny on hedge funds increased globally. So, because we're discussing about LTCM, let's also discuss about what is a black swan event in financial markets, and how is it related to the normal distribution, and how black swan event is linked to both normal distribution and risk management, and it can be used, basically how normal distribution can be used for risk management by hedge funds and insurance companies. So as I told you, black swan event is coined by a professor called Nassim Nicholas Taleb, and he basically considers this event as a highly improbable event and it lies outside the normal expectations. And but it has an extreme impact. That event can wipe out your entire earnings, that or your models can just go haywire when that event happens. It seems predictable in hindsight, but when you look at the future, it you will think that it will never happen. Okay, so that's what a black swan event is. Examples of black swan events are 1987 Black Monday. So Dow Jones dropped 22% in one day. First global market crash caused by computerized trading. Dot-com bubble bust. Tech stocks collapsed in 2002. Tech stocks collapsed. Nasdaq fell 78%, and billions were lost on this. 9/11 terrorist attacks 2001. Market shutdown. Global security restructuring. Economic losses $2 trillion in this. Global financial crisis in 2008, collapse of Lehman Brothers, housing bubble burst, markets crashed worldwide. COVID 19 pandemic in 2020, lockdown, supply chain disruptions, market panic, oil prices went negative temporarily. Russia Ukraine war in 2022, commodity price shocks, energy crisis in Europe, and AI driven market disruptions, which is going right now. Rapid automation, mass job displacement risk, valuation bubbles. So these are the main black swan events which happened during our lifetime. So this is the normal distribution. So if you see this normal distribution, this is the mean, which is zero. This is standard deviation, one standard deviation, positive and negative, two standard deviations, positive, negative, and three standard deviation, positive and negative. Okay. So 34.1 and 34.1, around 65% people will lie within the one standard deviation. This can be applied to multiple things like height of the people, or people even dying. Also, you can apply this normal distribution, because this is a phenomena, or this is a pattern that happens in the entire universe, and it is applicable to pretty much everything. And all these life insurance companies, even the financial companies use this model. Life insurance companies use this model a lot. Even the financial companies also use this statistical model. So most likely the event that happens is within the 65%, and then the next likely is this within 36, this other 13.6, which is around 27%. So this is the next within the two standard deviations. This is the next probable event, which has a 13.6% chance of have people fall into that particular thing, or events fall into that particular thing. Then we have two standard deviation to three standard deviation, which is 2.1 to 2.1 percent. So this also, there's a 2.1% people will fall into this. And then when we cross the three sigma, three standard deviation is 0.1%, 0.1%. And this 0.1%, when it happens, all your models will go haywire, and you will basically all correlations, whatnot, quantitative models will just go haywire, and your management is put under stress, and you will lose the entire capital during that particular event if it's not managed properly. Okay, so about 99.7% of values lie within the 3 sigma, which is 3 standard deviation. And what is a black swan event? Normal models underestimate these extreme events. These extreme events are very rare. In rare markets, fat tails happen more often than predicted. Black swan event lies in the tails, events that should happen once in a million years, but they happen very frequently. It should happen once in a million years, but if you see, it's happening pretty much every 13 years, or even 1 year also, it's happening. Okay, 7 years, 5 years also, it's happening. LTM collapse in 98 occurred due to the reliance on normal distribution models that didn't predict tail events like Russian default. This risk management and normal distribution, this is used by hedge funds. Value at risk, so predicts potential loss in a portfolio based on normal distribution. So 95% value at risk is equal to 10 crores example, means there's a 5% chance of losing more than 10 crores in a day. Monte Carlo simulations are used to generate thousands of outcomes using normality. Sharp ratio assumes returns are normally distributed. Limitations: these models break during crisis because correlations change and volatility spikes. These are used by insurance companies, actuarial models, poison distribution to assess life, health, and catastrophe risks, reserving and underwriting based on historical loss ratios and claim frequency models. Tail risk reinsurance attempts to cover low probability, high impact events. Challenge is natural disasters or pandemics fall outside of model expectations. What are the risk management lessons we can learn is avoid over reliance on this historical data, use scenario analysis, not just normal models. Factor in fat tails. So whenever assume something can happen outside the normal distribution, use models like power law or log normal distribution. Stress testing is critical. Hedge funds and insurers must model unlikely yet plausible events. Diversify across asset classes and geographies. limits concentration risk due to tail events, monitor real life time changes in correlation and volatility, especially during crisis events. So these are the risk management lessons. Alternative models to handle black swans are extreme value theory, focuses on tail risk, not the center of the distribution. Power law distributions, better suited for market crashes or wars, and cupola models, which can help you simulate dependencies that break during crisis. So that's the video for today, guys. The LTCM, Long Term Capital Management Hedge Fund, and how it was founded by great founders, was performing superb for 3 years, and then went down due to one systemic risk or an event, black swan event. And what are the lessons we can learn in terms of risk management with this particular company? And we also discussed about black swan event, normal distribution, and how it relates to hedge funds and the risk management. So thanks everyone for joining the call. Have a nice day. Bye.